In this video, we're going to talk about 3 ways to invest more safely and lower your stock market risk. But you knew that because that was in the title. So let's get started. How's it going, everybody? Welcome back to the channel. My name is Jay, and today I'm giving you 3 ways that you can invest your money more safely and lower the risk you take on when you invest in the stock market. And I'm not talking more safely as in plowing all your money into bonds or buying a whole bunch of CDs or anything like that. We're talking about investing in stocks in the stock market, but how to lower your risk in doing so. And the first way to invest more safely and to lower your risk when investing in the stock market is to keep a cash reserve on hand at all times. Now, more commonly, we'll refer to this as an emergency fund. You want to keep those 3 to 6 months of expenses liquid in cash in a savings account or money market account or something like that. And usually when we talk about having an emergency fund, it's from the aspect of if you have a large expense come up that you can't cover in cash, you don't want to have to go into debt or anything else to be able to pay for that. But that can also work with your investments. If you have a cushion of cash on hand, if you have cash reserves outside of your investments, when something comes up in your life, like a large purchase or an expense you didn't plan for, it means you can cover it with that cash and you're not forced to sell any of your stocks or investments at an inopportune time. So that's why the first step to investing more safely and lowering your stock market risk is to always keep a reserve of cash on hand. The second way to invest more safely in the stock market is to dollar cost average. Now, I've talked about this before. I did a whole video on dollar cost averaging versus investing a lump sum. And the reason that dollar cost averaging is a good idea and how it helps you invest more safely and lower your risk in the stock market is because it takes out that emotional component to investing, or that human error that we can all be subject to. If I have $5,000 that I want to invest into Apple stock and I just invest it all right now, all at once today, I'm gonna be super concerned about, am I getting the best price right now? What if the stock goes down by 5% tomorrow and I could have bought it at a better price? Or, well, I'm not sure I'm really getting the best price today, so I'll wait till next week and see what happens. And then the stock goes up by 5% and you're wishing that you had invested that week earlier. By committing to dollar cost averaging and saying, okay, I have $5,000, I'm gonna invest it into Apple stock, but I'm going to invest $1,000 every month for the next 5 months, or $1,000 every week for the next 5 weeks, whatever it is. You're taking that guessing game out of the equation. You won't be second guessing yourself. You've committed to a plan and you are going to invest $1,000 every month or every week or whatever until you've put your $5,000 into Apple. By spreading out that investment over time, you're lowering your risk. So instead of investing $5,000 today at $50 a share, you can invest $1,000 today at $50 a share, $1,000 next week at $40 a share, $1,000 the week after that at $55 a share, and then $1,000 a week after that at $50 a share. You get the picture. You're buying in at a whole bunch of different prices, so when it's all said and done, it's giving you the opportunity to possibly end up with a lower average cost per share than if you had just invested all your money at once. Now, obviously, the inverse is always true, but like I said, by spreading it out, you're taking out that second guessing, you're taking out that FOMO, you've just committed to a plan and you're doing it. And the third way to invest more safely and lower your risk in the stock market is to diversify. Now, we've talked about asset allocation on this channel before and your mix of stocks and bonds and real estate and whatever. But even if you're just buying individual stocks, it's important to diversify. If you have $10,000 to invest and you invest your entire $10,000 into just one stock, well, then you've got everything riding on just the fortunes of one company. Now, that may work out great if that company does well and the stock goes up, but if the stock goes down, the company performs poorly, your whole portfolio tanks with it. Now, a better way to do that would be to spread your risk around to multiple stocks. Obviously, the more is better. Again, if you have $10,000 to invest, instead of investing that $10,000 all into just one stock, invest $1,000 into 10 stocks. Now, in that scenario, yeah, some of them may go up, some of them may go down, but the point is your entire investment portfolio doesn't have its fortunes riding on just one company. You're spreading out the risk and you can handle the ups and downs a little more. Now, obviously, my most recommended way to diversify is to not buy individual stocks when you only have $10,000 to invest, but rather invest that $10,000 into some index funds where you can get exposure to hundreds or even thousands of companies with that same amount of money, and really spread your risk out and lower the volatility of your overall investment portfolio. So give this video a like if you found those tips helpful, share it with your friends, subscribe to the channel down below, do all the things, you know what to do, and check out these two videos over here. I think they will help you become a better investor as well, and I hope to see you there.